please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
33 higher on the Nifty, 10,465. 102 higher on the Sensex, 34,449.
But on an overall basis, the Q4 quarterly results this far has been pretty decent.
We are in a period of volatility, extreme volatility. The US dollar is strengthening.
Whether government should levy a sugar cess or not. And yes, a lot of finance ministers had raised this issue.
But the NCLAT has made it clear that as far as the COC is concerned, both the parties in question, their bids shall be considered, both Tata Steel as well as Liberty House.
As far as JLR is concerned, the UK remains a challenging market. We have called that out explicitly. At the same time, we shouldn't forget the China market continues to do very well for us.
We're at the high point of the day, so it's looking good. We saw some bit of stability earlier on when we saw the EM currencies stabilize, and since then, it looks like the market has just taken off.
Sun Pharma ahead of numbers was up about 2.5%. Forgot to talk about ICICI Bank, that's up about 2%. HDFC was up about 1%. On the way down, Tata Motors, fresh 52-week low for that one.
Markets extend gains in the last hour. Sensex gains more than 400 points while Nifty recaptures 10,500. Bank stocks outperform, but mid-caps underperform, losing about 0.5%.
Oil producers like ONGC and Oil India slide in trade over fears of a windfall oil tax. Reports suggest the government could make this move to soften the fuel price burden on consumers.
Tata Motors slides nearly 7% after fourth quarter earnings miss expectations, but the company's new CFO is upbeat on FY19. He expects profitability to improve this financial year.
Pharmaceutical and IT stocks lead the charge for the bulls. Both the indices gain 2% each thanks to a weaker rupee and a more defensive posturing in the market.
NCC gains close to 9% after reporting fourth quarter numbers above expectation. On the other hand, Jet Airways hits fresh 52-week lows after reporting a loss of over 1,000 crore rupees in the fourth quarter. Well, those were the top 5 headlines from today's trading action. It was a day when the market saw a lot of short covering. Hello and welcome to Markets Today Talk Back, the show where we tell you all about 8 hours of trading. Today was choppy but ended in the green. I'm Lata Venkatesh, with me, Prashant Nair. Hi, Prashant.
Lata, hi. Some reprieve finally as we come to a close, almost to a close, a day left this week. Over the next 30 minutes, we, of course, will wrap up the day's trading activity in the top 5 stories. You heard those 5 stories. We'll take questions. To answer those questions, we have our market experts with us. So Prakash Diwan is with us and Mitesh Thakkar is with us as well. So we've got both fundamentals and charts covered. Gentlemen, thanks very much, both of you, for being with us here on the show. But let's quickly wrap out the day's trading action. What were the factors which drove trade from the start, Lata?
Well, first up, of course, yesterday the big fall came late afternoon because of mayhem or tumult, if you please, in the currency markets. And with that dying down, with Turkey raising its interest rates by 3 percentage points to stem a run on the Turkish lira, you actually saw calm in the US markets. US markets, of course, also recovered because the Fed sounded somewhat dovish. And then you saw some calm coming to the Asian and European markets as well. India saw, therefore, a sharp short covering rally, especially in the IT and pharma space. Because, well, the rupee has not really recovered. It, of course, was about a little better, 10 pice better than what it was yesterday. Separately, you had some bit of buying coming in, even in the Nifty Bank, because of the weekly expiry of options. More importantly, you found a lot of buying in stocks like HDFC Bank. Yesterday, HDFC Bank, as the marquee FPI favourite, foreign favourite, saw a lot of selling. We saw covering of Wednesday's late fall, Wednesday's shorts in particular. Coming to other stocks, you did see, continuing of profit taking wherever there was money. So the market sell on rallies has not changed to that extent. So good results. Bharat Forge, Motherson Sumi were some of the stocks that found selling. Similarly, stocks that did badly also found selling. Tata Motors, of course, one of those marquee headlines that we will analyze, as well as stocks like Granules, for instance. So profit taking if you did well and selling if you did badly. That continues. Overall, the theme of, therefore, selling in the market, selling every rally is continuing. So bears are to that extent in control, although the markets have ended in the green. But more stock-specific action and details from Prashant.
So, I mean, as you said, pockets of strength because the market looked quite okay. IT, I mean, pharmaceuticals and public sector banks. I mean, PSU banks another 1%. So it brings the total tally in terms of gains for that sector to about, what, 8 or 9%, maybe even more for the week so far. There's one more day to go. Auto stocks were weak. We had real estate stocks which were weak, and energy, of course, Oil India and ONGC. I'll come to that in a bit. So first, large cap gainers. Bharti will top the list today. And then you had the IT names, TCS, Infosys, pharmaceutical names, Sun Pharma, Aurobindo, public sector, SBI. You had gains in Bank of Baroda, and a private sector bank like an ICICI did 2% today as well. ONGC and Oil India, big swings. I mean, they were down 10-11% at one point, but then they recovered quite a bit. And meaningfully, ONGC is a heavyweight, influences the index to a large degree, was down about 4.5% by close. Broader losses, so Jet was down, fair number on the back of results. Tata Motors was down big time. You had Gas Authority of India, Motherson Sumi and Jain Irrigation were the other names which were lower. And in terms of gains, you had Just Dial, Kaveri, NCC, again, a bunch of news flow and results influencing trade for most of these names. Lata.
Okay, with that, let's take it to our guests. First, to you, Mitesh, what are the charts telling you? Will you wait for higher levels to sell? Will you wait for lower levels to buy?
Lata, I think we've been quite oversold, and today, we had something as at least, despite the fact that it was the Bank Nifty expiry, the banking index kind of signaling some kind of minor buy signals on the intraday hourly and the half-hourly chart. So I think the Bank Nifty, which enjoys a significant weightage in the Nifty, could see the Nifty also head higher. So I would possibly wait for slightly higher levels to go short. I believe that the structure still remains weak on a short to medium term basis, but on an intraday immediate basis, I think there could be a pullback. Having said that, I think on the upside, 10,600 to about 620 on the Nifty, I believe it would be a very difficult level for the Nifty to get past. So shorting around those levels is what I would explore. In the meanwhile, I think the banking index and the banking stocks can be traded with some kind of a positive bias.
Okay.
So that, Mitesh, thanks for that. It sets us up for the second headline. And so the big, among the sectors that were gaining in trade today were pharmaceuticals and IT stocks. Both the indices respectively were up 2% higher. Among tech stocks, the rally was led by TCS and Infosys and Tech Mahindra, which all rose on the back of a weaker rupee. Cadila Healthcare, Sun Pharma, Aurobindo, Glenmark led the charge for the pharmaceutical space. We've got some questions now. So a Twitter user, Juza, I hope the pronunciation right, has 400 shares of Tech Mahindra at 335 rupees a piece. He's been holding the stock since 2015, and he wants to know whether he can hold them for a couple of years more. I mean, he sure can, but should he, is the question. Mitesh, what would you tell him? Tech Mahindra.
I think I would be comfortable holding it, for a few more years or few more quarters, whatever his time horizon is, purely because of the fact that I believe that Tech Mahindra will continue to outperform as well as give you absolute returns. A good strategy here, possibly what I can suggest, is to trail his stop to longer term support zones, and I believe that areas close to about 620, 610 would be that, where the medium to longer term supports kind of start kicking in, and I don't see a downside below that. The stock had peaked out at levels of 750 way back in February 15, and I think once we cross that, then I think the stock can head towards 875 to 900 zone, which could be a good profit booking kind of a target.
Well, Tech Mahindra numbers due tomorrow, and expectation is that it will do 1.5 to 2% dollar earnings, but its margins expected to come in about 80 basis points higher, maybe 13.5, 13.7 thereabouts. It's consistently improved its margins. And if it could deliver a little over 13.7, I think the street will be delighted, especially because it's got the tailwind of the rupee behind it. But let me take that to Prakash. Prakash, Juicer. In fact, incidentally, I knew a Juicer. It's not an uncommon name. Yes. And in any case, Prakash, to Juicer's query on Tech Mahindra and generally, what would your view on tech stocks be?
So I think Tech Mahindra, while it's been a great performer, amongst the bigger ones,
I think the competitive intensity is going to see a little bit of a shift in terms of the leadership or the positioning, and that's one of the reasons why Infosys is also looking at making a comeback after a long time. So I would believe investors would be better off, Lata, going into the mid-cap IT space even now. And then we've seen the way the Hexawares and FSLs, KPITs of the world have delivered. I think one name that stands out, and then I'll tell you the theory behind this, the rationale behind this, and this is Zensar Tech. We saw the way PE ownership has changed the profile for so many of these companies, whether it was Emphasis, whether it was Hexaware earlier. Even this company has a pedigree which is now very different, and that's really making it go forward in terms of go to the market strategy that most of them adopt, and then start mining client databases for relationships for newer businesses. So look at Zensar Tech. It has been a quiet performer, but not yet on the radar. Could probably be much better off than some of these biggish names that we discussed.
Okay, well, that's more advice for you, Juicer, if you're listening. Incidentally, Tech Mahindra, I think, is the best IT stock gainer year-to-date on the Nifty. And even after that gain, I think about 30%, even after this gain, Tech Mahindra is, 12-month gain, of course, is 71%. But even after the year-to-date gain, it trades at valuations lower than Infosys or TCS or any of the biggies. So maybe you can say there's a little bit of headroom. I don't know. Let's get to the next question.
So we've got Niranjan Kulkarni who's writing in. He wants to invest in Cadila Healthcare. He's asking for a midterm outlook. So let's get a quick fundamental view. Do you track this one, Prakash? Cadila?
Yes, Prashant. So as a matter of disclosure, I do have a long-term position myself in this name. And importantly, what's appearing to be very promising here, Prashant, is the fact that this is one of the first companies to have reversed this negativity that came in with the US FDA inspections and issues thereby. So if you look at the kind of approval pipeline that some of the companies will start leveraging on, and this is luckily into business, into molecules and drugs which are not very high on competitive intensity, unlike Lupin and Sun Pharma, which really have a tough job in terms of making their market share back. But Cadila could probably be one of the bigger ones, first out the blocks in terms of the pharma turnaround. And my sense is it will have to give it maybe another couple of quarters to see that in the earnings get reflected very clearly. But if you have it, hold on, probably add on dips. This is a good level as any to really build it into the portfolio as well.
Fair point. Technical view, Mitesh?
Yeah, so I think, as of now, the stock has been making lower highs and lower lows, so I don't have a signal of a reversal as yet. My sense is maybe, where the guy can start accumulating slowly when the longer term support or the zones are being reached, where accumulation is recommended, and that is close to about 330 to about 310. So I think that's a good range, about another 10% downside if he gets in. I think excellent levels to start buying into this one. The reversal might happen after a few months of consolidation around these levels, but I think that's the best level to enter.
Okay, fair point. With that, we get to the third headline of the day. Fear of a windfall oil tax took a toll on oil producers like ONGC and Oil India, both falling between 4 and 7%. This move by the government, according to reports, could come with an aim to soften fuel prices. First, Sonal Bhutra is here to explain what this development means to ONGC. Sonal, it's just a report, but tell us.
Yes, oil producing companies like ONGC and Oil India were in focus today after sources told PTI that the government might levy a windfall tax on ONGC in offering to soften the fuel prices. And this proposal says that as soon as the oil prices cross the $70 per barrel mark, this tax may be levied in the form of cess. Also, under the scheme, the oil producers who get paid international rates for the oil they produce domestically will have to participate in this, and the revenue so collected would be used to pay fuel retailers so that they are able to absorb any spikes in the prices that cross this threshold limit. Apart from that, there will be minor tinkering in the excise duty rates as well, and also the states might be asked to cut down on the VAT rates. The stocks, they saw sharp decline by around 10% odd each, but they saw some recovery later when we actually pointed out that these companies have not been making premium above the $60 per barrel mark since quite some time. They are not, the realizations haven't gone above that mark. There is no windfall gains for them. I spoke to a lot of people and they also said the same thing, that this particular move will not be good for the likes of ONGC and Oil India. Back to you.
I mean, Lata, there's a the term coined by Charlie Munger called super deprival reaction syndrome, which basically means that it's about something that you think you're about to get, and it's the loss of what you don't actually have. It's the loss of what you don't actually have, which causes this extreme reaction. I mean, so I think people holding the ONGC stock went through a bit of that. I mean, never got beyond 65. I mean, and even if they get 70, that's the highest ever. And but I mean, of course, any upside, if oil goes back to 100 plus, they would of course miss on the upside. But this is still the best they've ever got. We caught up with the former ONGC chairman R.S. Sharma, and this is his view on the entire situation. Listen.
This will be a big loss to government's credibility. They have gone on record in international fora, roadshows, that we have deregulated the sector and these are the reforms, measures we have taken. Now, immediately going back on that, I feel the credibility is going to be majorly hurt. As it is in the exploration, no international companies are coming because of the contract stability, because of the, constantly government changing policies. So this would be the loss to the sector.
Okay. Well, there are questions on this. M. Srinivas has tweeted to us with a question on ONGC. Well, I just want to, before I put, Srinivas's question to our guests, just want to say that this is a PTI report. There is no confirmation at all that government is wanting to do or will be doing something in terms of levying any cess on ONGC. This is only a PTI report as of now. Okay, Srinivas is asking if the current levels are right for an investment in ONGC. Prakash.
Absolutely no. I mean, fundamentally, ONGC as a stock is not, it doesn't make the grade, Lata, for the simple reason that you have so much of, the vagaries of regulatory changes, policy fluctuation, just impact the stock so negatively that I haven't seen wealth being created in this in a long, long time. And my sense is that crude and its ramifications on our fiscal status is only going to make things even more complex. So you have mergers with the MRPL, HPCLs of the world. You have some, international acquisitions that don't make sense. So a lot of confusion that stems around this whole business for ONGC. So I would definitely stay out of it even at this price.
Okay. That's the word for you, Srinivas. Don't buy. Here's some opinion that we got from Manish Sonthalia of Motilal Oswal and Bryony Dukers of Aviva Investors. Stay tuned. We're back in a jiffy.
Overall, there has been some slowdown in flows as far as equities in India are concerned. I think returns and alpha underperformance, outperformance should be seen over a cycle. You had exaggeration on outperformance in the previous financial year, or let's say FY17. You had none of that, broadly in line in FY18. I think, if we want to get out of Indian equity markets and, particularly when the pain is more in mid-cap and small-cap space, you will be selling at the lowest point or broadly somewhere near the lowest point if you were to take a 3-year time horizon from now.
I think financials are an opportunity within India, but they're also a risk. I mean, we know that the public banks are in a mess. The government is working to rectify that, recapitalise. The bankruptcy law comes through. One would hope that that enables the financial sector as a whole to move forward. But it's a two-speed market. What we need to watch is the cost of funding. Liquidity is tightening in India and the cost of funding is growing.
So a good day for bulls finally after what has been a disappointing week, the first 3 days that is. We've been, of course, answering your questions and wrapping up the day's events in 5 stories. We got through the top 3 stories. Here's the 4th one. Tata Motors was the big casualty in today's trade. Tata Motors has been a huge underperformer in any case. The auto major posted a disappointing 4th quarter after market hours. Yesterday, JLR margins fell 220 basis points and losses continued for the standalone business. In fact, my colleague Sonia Shenoy caught up with Mr. P.B. Balaji, CFO of Tata Motors, and asked him about their plans for the volumes for the year ahead. Listen in.
As far as JLR is concerned, the UK remains a challenging market. We have called that out explicitly. At the same time, we shouldn't forget the China market continues to do very well for us, and rest of the world continues to do pretty well for us. Europe, from a situation of red, we have now moved it to an amber because we are starting to see growth coming through. And at the same time, US continues to remain challenging from the point of view of its traditional cyclicality that is there. Keep in mind that we launched 5 models last year, and all of them are going to get their full year impact this year. iPace gets launched in July. So the product pipeline is coming through very strong. Hence, we have explicitly called out that we expect, as far as FY19 is concerned, both growth and profitability to be better than FY18.
Okay, with that we go to the Q&A. Twitter user Chirag Vora has 30 shares of Tata Motors purchased at 336 rupees. Oh God, he's sitting on about a 50 rupee loss per share. He's asking if he should hold the shares for a year or sell them. Prakash?
I think it's a hold, Lata, and not necessarily just because he's 15% off from his purchase price, but for the simple reason that these kind of businesses take a long time to bottom out, and then the turnaround would be imminent. So my sense is it's equivalent to kitchen sinking in some of the bank balance sheets that we see that Tata Motors has done in terms of this one-time loss that it has taken on its standalone business. And if JLR China starts ticking in, they have certain great launches on the PV side. My sense is he will definitely get much more better than the 335 that he's entered in. So it's just 15% from where he is bought into. That shouldn't worry him in the long term. So just stay put, and definitely it will probably be one of his good picks in the portfolio in the next couple of years.
Okay, the fifth and the last headline then, and let's quickly look at the roll call of stocks which were buzzing in trade today. First up was NCC, which gained close to 9% in trade. Results came during market hours. It was a very healthy fourth quarter. Net profit, revenue and margins all beat expectations for NCC. Jet Airways, on the other hand, hit fresh 52-week lows after reporting a standalone net loss of over 1,000 crores in Q4. Stock ended 7% in the red. We had Granules India, which lost over 7% on the back of poor results. The company's net profit and EBITDA declined on a year-on-year basis, along with an increase in its inventory cost.
Okay, questions. Shubhadeep Roy has tweeted to us. He has 500 shares of Granules purchased at 85 rupees a piece. He's asking if he should hold or sell. He claims he's long-term, but let me toss this to Mitesh. Even if you're long-term, look at the way Granules moved today. What would you advise, Mitesh?
But it's not only today's movement. I think last few weeks the stock has been declining and has broken very key support levels of 100 to 105. I think that puts the long to medium term trend more on the downside, and I think now 105 would act as any kind of cap. So one, if he gets that price, exit. I think otherwise try and hold it to the stop below 75. There is some historical medium support area around the 75 zone. You might get a bounce back from there. But eventually, I don't think this is a stock which is showing signs of any, monthly or longer term uptrend. So no point holding this for long. I think either you exit around 75, or in case you're lucky enough to get a bounce back first, try to exit around 95 to 100.
Okay, well, if you exit at 83, you're losing only 2 rupees. If you exit waiting for 75, it may be a little dangerous if you're not so confident of that stock. And it's been a very, very steep fall, as you can see. In the past 12 months, lost 41%. We will wrap up this edition of Markets Today on that note. Mitesh and Prakash, thank you very much for joining us, and thank you all for watching.